Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. I'm your host, Joe Mosier. Thanks for tuning in today. Many of you, if not all of you, are familiar with the fact that in late July of this year, two Class 1 U.S.-based railroads, Union Pacific and Norfolk Southern, announced plans to merge and create America's first transcontinental railroad. The proposed entity that would result from this merger would encompass more than 50,000 miles of trackage across 40 states, actually more than 40 states. It would, of course, provide transcontinental service from the east and west coasts and would connect nearly 100 port facilities within the U.S. It would be just a massive operation, a huge entity driving much of the activity that fuels our economy, including agribusiness. Now, for reference, there's just 4 Class 1 railroads in the U.S. today. And so this would bring that down to remaining 3 and then trigger what is broadly assumed to be a domino effect, eventually consolidating the system down to just 2. Now, the ag industry relies upon the rail industry. Ag moves more than 3 million rail cars of grain, oil seeds, and ag products every year. That's roughly 10 to 15% of all rail shipments, if I understand correctly. And more than a quarter of all the grain handled in the U.S. supply chain each year, more than 25% of all of it, goes on at least one rail car ride in its life cycle. So any merger within the rail system is relevant to our industry. But this one, the UP, Union Pacific, and Norfolk Southern and NS coming together, this one demands special attention. And so today I'm really happy to bring to you a conversation that I had with Jay Shabat, who's the author of Railroad Weekly. You may not know of Jay, but he publishes a great and well-researched and very insightful industry newsletter looking specifically at railroad industry, the economics, financial performance, strategic changes, and a variety of factors driving the decisions and performance of that business. We're going to talk about the rail system in North America overall. He'll break down the Class 1 system, specifically getting into the financial performance and the trends that they're facing. We're going to break down and dive specifically into what is driving the UP and the NS to not just consider, but to actually pursue a merger of this scale. We'll speculate and talk about what the potential impacts to ag shippers may look like. We'll even talk about some of the early feedback that's coming from multiple stakeholders, employees and unions and industry associations, the competitors, et cetera. And then finally, we'll talk about what you need to be watching for in the weeks and months ahead as the process of this moves forward. We're still early, but these things do happen quickly once they get going. And so it's really important to stay informed, stay engaged, and really know what to be watching for. So whether you're served today by a Class 1 or a short line rail operator, or maybe even if you don't directly deal with rail at all, consolidation of this scale is going to have echoes and knock-on effects throughout agribusiness. And this is an important topic to pay attention to. Thank you for taking the time to tune in today. I hope you enjoyed today's episode of the Pacesetter Pod. And with that, let's jump over to my conversation with Jay Shabat of Railroad Weekly. Jay Shabat, welcome to the Pacesetter Pod.
Thanks, Joe. Good to be here.
Excited to have the chance to talk with you today about a very important development within the North American rail complex and considering what might be considerations and impacts to our listeners who are in the agricultural segment. So we're going to be breaking down and talking about the proposed UP-NS Class 1 rail merger today. We're going to talk about some broader overviews of the industries and a couple other interesting and important facets to that. But before we get into the topic of the discussion here today, Jay, give us a little bit of background, give our listeners a background on who Jay Shabat is, your work within both the rail and the airline industry, and some of the work and content you're producing today.
Sure. Thanks, Joe. Yeah, I'll do that. And so I, as you alluded to, I actually am an airline guy originally. I started my career working for a couple different airlines, worked for the old U.S. Airways. Some people may remember that. It's now American. I worked for Air France a little bit in New York City. So that's really been doing that for, then I started an airline newsletter, an airline industry newsletter more than 20 years ago. So I've been doing that for a long time and I still do it. That's still kind of my, everyday job is writing an airline newsletter. But about, I guess it was 2021, so a couple of years ago, I added railroads to my portfolio, and I do a railroad newsletter as well. And it's the newsletter I write is called Railroad Weekly, and we cater to a lot of it's railroad executives, but also anybody who really has any business with the railroad. So it could be suppliers. I'm a rail car manufacturer, and I sell rail cars to the railroads, or a lot of lawyers, bankers, consultants, really people that need to know what's going on at a very high level in the industry, very, very finance heavy, et cetera. So, that's a little bit about, what Railroad Weekly is. And I remember starting it a couple of years ago thinking, would this be really as interesting as the airlines? I don't know. Is this like an old sleepy industry? And I quickly discovered it's anything but sleepy. I mean, we had huge, obviously the COVID period was very eventful. And then we had all sorts of labor unrest. And now we have this big giant merger proposal. So there's always a lot going on. That's for sure, Joe.
Yeah. Well, I'm excited to have you on the show, Jay. One, I've enjoyed following the newsletter since I came to be aware of it right around the time that the UP-NS merger was announced earlier this summer. And I think this new media world where individuals such as yourselves, analysts that are deeply and passionately curious about a subject, willing to put in the time to collect, consume, and then aggregate data and insights and feed it back to different stakeholder groups is really powerful. And, you think about modes of transportation, railroads can look at it as infrastructure because it is a CapEx heavy business with a lot of physical infrastructure involved. But if you think of modes of transportation writ large, the inland waterway system, ports, the railways, the highways for over-the-road trucking, the airways, I mean, modes of transportation are, arguably an element of the plumbing of our economy. And in the agricultural business and agribusiness, nothing moves digitally other than information. We deal in bits, or atoms, not bits. And these things have to move around. While we're not yet at a point where people are necessarily flying specialty grain from one coast to the next, it's still going in other modes. I just think it's really interesting to have someone like yourself on. So I appreciate you taking the time. Let's talk now about, let's do some context setting, I guess. We're going to dig into the potential Class 1 consolidation of railroads in the United States. But before we do that, can you maybe provide an overview of the railroad industry generally and some of the key stats, namely things like what is a Class 1 railroad? What does that mean when we say Class 1s? How many are there? And what do they represent in terms of trackage, percent of the market, volumes, et cetera? Just so we understand why it's such a big deal that we have even a proposed discussion of two major Class 1s.
Sure. So there are these, if we're looking at just the United States, and we can, expand the conversation to Canada and Mexico, because it really is sort of one big rail market in a sense.
Thanks.
Yeah. So in North America, we can, let's just stick with the United States for now. We have 4 of these, what we call big Class 1 railroads, as you mentioned. And that's just the class is just a definition by the amount of revenue. But these are just the big giants, let's say. There are another set of about 600 or so, what we call short line railroads. And some people call them feeder railroads or spoke railroads. They cooperate very closely with their Class 1 partners just to move goods to where they need to get to. But the real big ones are these big 4. And there's 2 in the West and there's 2 in the East. So the 2 in the West are BNSF, that's owned by Warren Buffett's Berkshire Hathaway. And there's Union Pacific. They're roughly the same size in terms of the amount of revenues that they generate. Union Pacific last year, about $24 billion in revenue. BNSF was about $23 billion. So, pretty close. Then over on the eastern half of the U.S., you have another 2. One is CSX, which is about $14.5 billion in revenue. And then Norfolk Southern, which is about $12 billion. So smaller than the West Coast guys, but still, very, very large. And then, just to extend the conversation to Canada, there are 2 big Canadian railroads. The Canadian National, based in Montreal, they're about 10 or 11 billion in revenue. Actually, a little more like 12 billion. And then right behind is CPKC, which is the product of a merger that just happened a couple of years ago between Canadian Pacific and Kansas City Southern. So that was the most recent big merger that happened in the United States. So that's kind of a lay of the land. The one thing I did want to say, and then there are two big railroads in Mexico as well. There's Ferromex, which is actually about a quarter owned by Union Pacific, and then CPKC has their own wholly owned Mexican railroad as well. So if you combine the two in Canada, two in Mexico, 4 in the US, that kind of gives you a big picture of who the big players are in North America. And I'll just say one more thing, Joe, for context here, is all of these railroads that I mentioned are very, very, very profitable companies. And I always like to joke that, the airline industry, they have no problem growing, but they have a devil of a time making money. And it's the exact opposite in the railroads. So the railroads, just to give you some numbers behind that statement, if you're, a very successful airline like Delta Airlines based in Atlanta, for example, in a very good year, they'll have an operating profit margin of, maybe if they're lucky, 14, 15%. Well, Union Pacific, that number is going to be like 40%, 40. So these are some of the most profitable companies in the entire U.S. economy. So just for context there, consider that.
Yeah, it's interesting. So when we say east or west, we're largely saying east or west of the Mississippi River or Chicago as kind of one of the main intermodal points in the U.S. Based on the statistics that you put out there with, the BN and the UP being at 23 and 24 billion respectively. And then on the other side, their U.S. Class 1 partners, CSX at 14.5 billion and Norfolk Southern at 12. What makes the Western U.S. so much of a bigger piece of the pie? Is it just given the nature of the products, the extraction, the agricultural production, or is it more competing modes of transport on the Eastern Seaboard? Things can move by truck over shorter distances between MSAs and cities, or what's the dynamic there that's kind of causing that sort of uneven revenue distribution?
Yeah, I think you mentioned most of the big reasons there. So one, as you said, first of all, the West is just, the territory is larger than the East if you divide it across at the Mississippi. Secondly, as you mentioned, because of those longer distances, generally speaking, the longer the distance, the more likely that freight is going to travel by rail rather than truck. The economics just get better over longer distances. So that's another reason. And then I think you mentioned this as well. There's so many rail heavy type, or let's say freight that's more likely to travel by rail in the West, like the agriculture, the bulk stuff, chemicals along the Gulf Coast. Of course, you have the big giant ports that Los Angeles, Long Beach, that bring in like all those containers. So that's roughly why the two Western guys are going to be a little bit bigger than the Eastern guys.
Okay, thank you for that. So you mentioned the CPKC Southern merger, which occurred, I think, back in 2023.
Yeah, sounds right. Did it close in 23?
Yeah, so relatively recent. So Canadian Pacific and Kansas City Southern. That's one of the most recent meaningful mergers of major railroad entities coming together. Again, it's the ink is still a bit wet on that one, depending on what longitudinal period you're looking at, but it's in the last couple of years. What have we seen in terms of the impact in the industry, or what are we hearing anecdotally as relates to level of service, rail rates, infrastructure investment? Has it accrued value to the industry, and has it accrued value to the shippers in the process as well, or is it still too early to kind of render a judgment on that?
Yeah, great question. I'll start with kind of the negative thing to say about it with that merger is they promised more growth than they've delivered. So during, when they were trying to get approval for that, and the process for these railroad mergers to get approved is they have to present their proposal to the Surface Transportation Board in Washington, and they ultimately decide. It's a 5-member board. I think there are only 4 currently seated, but they ultimately decide the fate of these mergers. And, when CP and KCS made their proposal to the STB, they promised, we're going to grow traffic X% by, in the next 2, 3 or whatever. That they haven't been able to do that. Now, some of that hasn't really been their fault. There has been a really difficult trucking recession. So a lot of that growth is premised on kind of grabbing market share from trucks. And there just hasn't been that much share. There just hasn't been that much traffic to steel because for a variety of reasons. One, there's been a lot of overcapacity in the trucking industry. So if you're a shipper and you're considering, I like this CPKC offering. I like what they have to offer, but I can still stick with shipping my stuff by truck because it's so cheap because they have overcapacity in the industry. Mm-hmm. So there's been some of that. We've also had kind of let's call it an industrial recession over the last couple of years, or at least not much growth in the industry. If you think about some of the big products that railroads haul, whether it be, chemicals or, steel, whatever, that part of the economy hasn't grown much over the past couple of years. So all of that is to say that that's been a little bit disappointing. Now, on the other hand, if you listen to a lot of shippers, particularly the intermodal shippers, I could think of a few off the top of my head that have been very pleased with what CPKC together have offered. New lanes, just new ways to get quickly from one market to another. They don't really talk too much about pricing, but I'm sure they've negotiated some deals that are attractive to shippers. So I think overall, despite what I said in the beginning, I think overall it's been a rather successful and smooth merger. They've had some issues with, IT integration. That's very common. Mm-hmm. That, lasted a few months maybe, but, it seems to have passed now. So I think overall it's been successful. Certainly, for the companies themselves in terms of their, the value, the profitability that they've been able to derive. I think that's been, they've been very happy with that. And all that's, kind of a prelude to Union Pacific thinking, well, if it worked well for them, maybe a merger might work well for us.
Yeah, that's a perfect segue, and so to kind of set the context here, and I'm sure that all of our listeners have actually been paying attention or aware of this news, but let's just go through a couple of the statistics around it. In late July, if I recall, the last sort of 10 days of the month, Union Pacific and Norfolk Southern, so a Western Class 1 and an Eastern Class 1, they announced plans to merge and, quote, create America's first transcontinental railroad, meaning serving both coasts of the United States. And so the proposed company, as I understand it, would encompass more than 50,000 miles of trackage of rail line across more than 40 states. As they said, it's going to provide transcontinental service from the east and west coasts. It'll ostensibly connect nearly 100 different port facilities, which is interesting. And so it would be a real monster of an operation. And if you just combine the revenues that you cited earlier, Jay, that's a nearly $36 billion operation. So 1.5 times the size of its next closest competitor, which would be BN. So obviously going to get a lot of attention. It's not a highly fragmented Class 1 system as it is. Short line is obviously much more of a distributed network, but monster of an operation. Given how profitable they are, given that maybe some of the growth from the CPKCS hasn't materialized as expected, what do we know about the why behind the proposed merger for Union Pacific and Norfolk Southern?
Yes, I think there's a few different motivations. I mean, first of all, I should say that Union Pacific does have a relatively new chief executive, Jim Vena, who started about 2 years ago. And so I think he came with a fresh perspective, thinking about how Union Pacific could create more value. And I'll just go back before Jim Vena arrived, Union Pacific, and to be fair, really all the Class 1 railroads, particularly U.S. ones, had an extremely difficult, 1 or 2 years coming out of COVID, where they faced very severe labor shortages, which translated to very severe operational difficulties. And some of the people listening to this right now maybe experienced that back in 2022. So UP, for one, was going through all that sort of distress. There was also the big near labor strike in 2022. So coming out of that, I think, Jim Vena arrives in 2023, and I believe I have my dates right. I think it was 23. And he's, thinking, what maybe could I do to add some value here? And most importantly, as I mentioned before, nobody's going to complain about a 40% operating margin, but I think the Class 1 railroads are under a lot of pressure to grow. There's an analyst, Loop Capital is a company that's it's an investment company, and an analyst named Rick Patterson, who I was listening to him give a presentation last week, and he was showing data that Union Pacific is carrying less freight now than it was 20 years ago. Now, a lot of that is coal. Coal is just just a lesser part of our energy system today. So there's just less business there. But it's not just coal. It's, he showed other categories too, where UP has been a shrinking company. And the railroads don't like that. I mean, the railroads don't like that because a lot of their stakeholders don't like that. I mean, regulators don't like that. Their unions, who wants to work for a company that's not growing? There's no opportunities to advance. Shippers don't like it. Even environmentalists, there's a lot of people who say it's cleaner to move freight by get it off the highways, move it on the rails. You get less emissions that way. So they want to see the railroads grow too. So there's this tremendous pressure for railroads to grow, and they're just having a devil of a time doing it, especially since the sort of the railroad centric freight is that part of the economy hasn't been growing, as I mentioned. So for so many reasons, just been really, really difficult. So here we are. And Jim Vena says, maybe we have a good opportunity here. There's also, investors that are a little bit frustrated recently with the stock prices of these companies not really moving much over the past year or two. And they also want to see some growth and some additional stock value. So there's some pressure there. So you can see where all these pressures are converging. And, here Jim Vena comes along. And then we do have the new Trump administration, which perhaps, I think this is open for debate, perhaps is going to be more amenable or more, more amenable to supporting a merger than maybe the previous presidential administration. So you sort of combine all that and you can sort of see what Jim Vena was thinking here. Maybe we can combine these two railroads, ignite a whole new avenue of growth here. And, will it actually, can they achieve that? That's a big question. A lot will be at stake when Union Pacific goes through its process with the STB of trying to get this approved. They'll almost assuredly have to concede some, they might have to say, okay, we're going to give up some real estate to our competitor to make sure that we don't abuse our market privilege or whatever. Let's cut some deals with some shippers so that they support it. In the last 2 weeks, as a good example, I think it was either last week or the week earlier, Union Pacific basically said to its largest union, in writing, they did this in writing, we will not lay you off, no involuntary furloughs for the rest of your career. If all you got to do is the union's got to support this merger. And the union accepted, this is the union that represents the conductors. So that is a concession.
Is that a national union then, or is that a union representing the Union Pacific conductors? Would they have to file the same sort of commitment with the NS conductor sort of group, or is that a national union?
So it is a national union, but this agreement specifically applies to Union Pacific. And of course, if the deal goes through, the merger deal goes through, it would apply to all of Union Pacific, including the new Norfolk Southern part of the network. So yeah, that's a pretty big size concession. You can see why workers might find that attractive. So, ultimately, will all those concessions be so costly that it kind of nullifies the benefits of the deal? That's the risk. And we'll just have to see how that plays out over the course of the next year and a half. These things do take a while.
So if I'm hearing you correctly, at least on the UP side, they're not necessarily responding to threats in the form of, facing extinction level events or failure to generate profitable returns, et cetera. It's more of a slow growth story, pressure from the analyst community, pressure from investors, and that sort of general malaise that sits on companies that aren't growing, and sort of what that does for the engagement, excitement, and sort of interest of the employee and management base.
Yeah, I think you said that well, yeah.
How about on the Norfolk Southern side? Is there anything that's different in their story that would cause them to want to pursue something like this? Given that while it is a merger, they're significantly smaller of the two entities, and thus traditionally in these types of transactions are a disadvantaged party. even if they're profitable and successful at the time that the deal transacts.
Yeah. So Norfolk Southern's perspective is a little bit different, maybe even a little bit simpler. If someone comes along and offers you to buy your company for more, considerably more than what your stock is trading at in the market at a given time, they're going to have, have to be responsible to their shareholders, and it's you can see why they would accept an attractive deal like that. UP did offer, a nice premium. And more than just that, though, it wasn't as if Union Pacific just showed up at their door one day and said, "Hey, I want to buy your company. Here's a big premium." The two sides have been talking for the better part of this year, and maybe even talks may have started late last year. And Norfolk Southern, I think, was in a situation where they had they were hit with a couple of really, really unfortunate shocks. I don't know if even shocks is the right word. They're just setbacks, let's say. So one was, of course, this unfortunate incident in East Palestine where one of their trains derailed, and it was I'm sure a lot of if you're watching this, you're probably familiar with it, but very high profile, unfortunate event that cost them an extraordinary amount of money and set them back in terms of they had a strategy that they were pursuing, and you can imagine their executives were just spending so much time dealing with this East Palestine incident that it really did set them back. Their profit margins showed it. As I mentioned, railroads they're no matter who you are, you're very profitable, but they were considerably less profitable for a couple of years than the other guys. So they were kind of under a lot of pressure to do something too, to make a big move. On top of all that, they kind of lost their CEO. Their CEO essentially was fired for misbehavior. I'm trying to find the right word, but he was forced to step down. And on top of all that, they went through a very tense situation where an investor came in and tried to topple their management and redo their whole strategy, and criticized them very in public, very, very aggressively. And that situation definitely was a distraction as well. So you can see there was just a whole bunch of stuff going on at Norfolk Southern that would, put them in a situation where it'd be like, hey, if the right offer came along, if we can assemble this really interesting transcontinental railroad that would, that makes sense strategically, that would allow us to grow, that would, let us put some of these past, this past drama behind us, let's go for it. So that's some of the thinking there.
That's interesting. And you can see why, two very different stories bring two management teams to the same conclusion. And as you said at the start, it might not be even any more complicated than we're tired, we're wore out, it's been a tough stretch. And if someone's willing to pay a premium on top of a business that has not been coming out of its best last few years, you almost have to entertain that. You don't have an option from a fiduciary standpoint.
Yeah, and it was that same situation too, where Norfolk Southern had this plan, the very intricate plan to grow. We're going to grow by just adding new lanes and services. We're going to make our customer service better. We're going to introduce some new technology. We have some new industrial development happening along our lines and in our territory. And it was all and the railroads will still talk like this today. Norfolk Southern still talks like this today. And in fairness, a lot of it is totally reasonable, totally makes sense. But for some of those reasons I mentioned earlier, the slow industrial development of the economy, all that kind of stuff, they just haven't been able to really grow much. So another reason why they would be looking for an alternative path.
Thank you for that. Let's start to talk then specifically about what this might mean for the ag shipper community and agribusiness generally. Because I think what we want to do today is we're breaking down this proposed merger. What's the contextual environment? What's the rationale business case that's bringing these parties together? But what's really important is for our listeners who are served by, frankly, any of the railroads, but particularly if you're serviced by UP or NS, thinking about what this could potentially mean and starting to get an idea of how you might respond to that, how you might adjust, what it could mean for your strategy and your business going forward. So bear with me here as I take some numbers that I've collected from recent media reporting and things like that. I don't go to ChatGPT for my statistics because I watch too many other people get embarrassed by having, the hallucination of an LLM. And so they cite it as fact. This is actually coming from media, so perhaps it also is derived from an LLM, but I don't know. But it's been reported that about 3 to 3.2 million rail cars move every year. They move grain, oilseeds, and ag products. And that represents a double-digit percentage, somewhere in the 10 to 15% of all rail shipments that are moving within North America. And that's also 3.2 million rail cars of grain, oilseeds, and ag products. That's more than a quarter of all the agricultural products that are handled in the U.S. supply chain. More than a quarter of all the grain is going on at least one rail ride in the ag supply chain. So, you don't really have a North American agricultural complex that looks anything like we have today if you don't have a rail system. And so it is a very important part of the business and basically bringing products from times and places of surplus to times and places of deficit, which is fundamentally what this business is all about. Now, I know we can't opine specifically on what the experience would be for ag shippers post-merger. We could speculate, but maybe that's probably not as additive as we'd like it to be. But I know you've looked at a number of consolidations in the past, Jay. And so thinking about ag shippers on this combined network, what would you surmise would be some of the likely or potential impacts that they should be thinking about? I think there's always a presumption of rates are going to rise and services going to fall, but those are blunt instrument sort of statements, right? Those won't be universally true across the system. But what would you encourage ag shippers to be thinking about, or what would be the most likely impacts of a significant merger like this?
Yeah, no, so I think you're right to point out that ag shippers do face the potential of fewer competitive options. It is true that maybe they, where they used to be served by two railroads, they now are only served by one. Now, of course, remember in this case, Union Pacific and Norfolk Southern, they don't overlap. You're just connecting them.
Yes, exactly.
But still, there could be some lanes that, maybe where there's an impact to shippers. And then, as you mentioned, there's always concerns that with more market power could potentially become more pricing power. And that's, not good if you're paying more and you're a shipper. Now, I think the approach right now from a lot of the shipping, there are big groups that represent rail shippers from different industries. One example is the NGFA, is that the National Grain and Feed Association, I think. They have commented on this merger. And their position at this point is basically, look, it's too early to really, say we definitively oppose it or we enthusiastically support it. We really have to wait and see. We have to wait and see when the STB starts holding hearings. Even before that, when the Union Pacific and Norfolk Southern present their formal merger proposal, which will describe exactly, what they plan to do, there's going to be opportunities for ag shippers, particularly if you're a big shipper, particularly if you have a lot of, if you're a big customer of UP or NS, there will be opportunities to negotiate perhaps some concessions or some new rates or some, hey, if you publicly support this merger, I will promise you this over the next 3 years. Or there's going to be some horse trading, let's call it. But we don't know what that is yet. A lot of it will be private, a lot won't be disclosed. So it is really at this point, at this early stage of the game, and hopefully, Joe, we can come back maybe 6 months from now, a year from now, and talk more about the latest and how things have changed. But at this point, it really is kind of a wait and see. Let's see how this is going to impact different stakeholders, different times, and really not too much more we can say at this point about, how it's going to affect individual shippers.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
I read something, and I'm looking at my notes here, and The entity I cited was the RCC, which you may know who the RCC is. I'm now forgetting for a moment. It's maybe a railroad customer.
It's a
network.
coalition of different. Well, they basically, I don't know if they like to call themselves lobby groups, but that's the easiest way. Yeah, just we represent chemical distributors and we represent steel manufacturers. So they came together and for the purpose of speaking as one voice.
Yeah, so just going to think out loud for a moment and get your perspective on something. So I don't have the time period here in front of me, but they referenced there's a pretty steady, reliable surge in rail rates following rail mergers. And particularly this surge has been most pronounced over this last recent period of X number of decades, where we've gone from more than 20 major freight railroads down to just the 6 across Canada and the U.S. that you mentioned earlier, 7 if you include Mexico, or I guess 8, depending on how you treat the CPKC. But with reduced competition, profit margins have soared, rail rates have gone up, and the goods shipped by rail have shrunk, as you said. So in many ways, profitability is up, rates are up, volumes down. And they cited a statistic here that said that rail revenue from potentially non-competitive rates, meaning where a shipper would only have the one option, revenue from those rates has surged 265% since 2004. So roughly the last 20 years. And if you compare the growth of rates with a set of places where there are presumed competitive rates, meaning a shipper has options, those rates have only gone up 50%. So a 20-year period, if you have competitive options, your rates have gone up 50% over 20 years, or 265% if you don't have those options. I guess that's pretty shocking to read, and it'd be very troubling. But also I think about the majority of the assets that we work with, that I've worked in and work with. It's very rare that one of the ag shippers that we work with actually has the option of more than one class 1 railroad. Sometimes there might be it's 20 miles south to the UP and it's 40 miles north to the BN. That, those economics are different just based on the shipping rates, truck rates to get it there. But you rarely are sitting on both lines at the same time. So I guess my question with all that is the lack of competitive rates, is that really that big of a risk, given that, as you said, the UP and NS, if you're served by the UP today, but you can also ship to the BN, that option exists tomorrow, right? And you're not necessarily shipping, you're not choosing between the UP or the NS when you're shipping your product, unless you happen to be somehow right on the river, in which case you may very well, from an ag standpoint, hitting a center Gulf export market anyways by boat. So I'll stop there before I belabor the question anymore.
Yeah, no, I mean, your point is a good one, that the two networks don't really overlap. So it's not like, imagine if UP merged with BNSF and how many shippers would you would be monopolized. So you're right. I mean, you can see a situation where maybe, a shipment from, I'm just making this up, but, North Dakota to Atlanta, it could go on, and you're captive to the UP, let's say. Well, it could go on, UP to NS, or right now it could go to, UP to CSX, or, there might be some different short line options involved and things like that. So you can see, they're going to redo UP's going to kind of, redo their system and route things different ways. And there's still a chance that it could be harmful to consumers or to the shippers. If that wasn't the case, I don't think some of these coalitions would be so vocal. So, we'll have to see how it pans out. I think with these coalitions and these quote unquote lobby groups, I think a lot of what you're hearing and some of the stuff that you've just read, I think that's somewhat pre-positioning arguments in advance of the STB hearings, so that they'll be able to go in and maybe get some concessions.
Sure.
Or, maybe I think some of that is just, negotiating tactics. I'm not disputing their numbers. I mean, I'm sure they did their homework, but I'm sure, at the same time, when the UP makes their argument before the STB, they'll have numbers too, and they'll, I'm sure, present the prettier side of the picture. So yeah, it's, I hate to go back to my point there. That's, it depends, and we'll see. I know that's kind of a cop-out answer, but I think it really does. The outcome for everybody does have a lot to do with the exact nature of the concessions that are involved in this, the exact nature of the conditions that STB applies, if any. You would think they would. One example, a shipper who's maybe captive to the BNSF, but maybe has, is not that far from the UP, maybe could take advantage of what's called like reciprocal switching, where the railroads are kind of forced to provide rates to ship on each other's railroads. So, there's different kind of competitive remedies. Now, I've heard people a long time in the industry that say a lot of these competitive remedies, they don't have a great history of working very well, but they could provide perhaps some relief in some situations. So that's it is a very much let's see how this all plays out kind of situation.
Something I meant to ask you earlier, if we think about that strategic posturing ahead of an STB review, right? You start to get your messages out there early and almost start to force the parties to contemplate what might be concessions they could offer that would be favorable to the opponents of the merger. So you start that, not to be cynical, but I think that is a strategic move to do that kind of thing. You mentioned much earlier in our discussion the likelihood that just in terms of trackage, there would likely have to be some sort of divestiture from the newly combined company to maybe bring into some balance or some ratio the amount of trackage they own in one particular geography of the other. So let's just, for the sake of fun, let's say that one of the conditions of a UP-NS merger was that that they're going to have to divest of 15% of the legacy NS's currently owned real estate and rail. When that happens, do those typically transact to short line carriers that will ultimately then be feeding that combined entity's lines anyways? Or do they also try to push some of that divested infrastructure to other class ones to kind of build them up regionally? Any sort of sense of how that works, or is it really case by case and transaction by transaction?
I mean, it could be both. It's I think in the past, there were mergers in the past where both of what you described happened, where there's trying to think, I was going a little bit before my time, but when the Union Pacific merged with the Southern Pacific, that was somewhat controversial and heated because there's a lot of overlap there. And there were situations, and I don't know specific examples, but, where UP was forced to allow BNSF to use some of its track into, I'm just making this up, but, into Houston to get to a port or something like that. Mm-hmm. So yeah, you can do that. Or short line might come in and provide some, extra competition. So all of those things, could be maybe, shared terminals, intermodal terminals, whatever. It could be a variety of different ways to make the situation a little bit, more competitive.
Okay. So one of the things I'm thinking about here is if I'm a grain terminal that's loading shuttles on the current UP complex, and I'm often shipping to Center Gulf, but occasionally an option will create itself where there's a local deficit or deficit market whereby I may be hitting a southeastern market, a non-traditional trade from the west all the way into the southeast to feed, the chicken feeder market or something like that, for example, et cetera. One of the ways to contemplate what could be the potential impact is how often are you actually shipping on something that would go across both of those legacy rail lines, and would a combined entity actually provide perhaps better, smoother service, fewer counterparties, more reliable sort of transportation and quality management for your products? Or is it, frankly, not a relevant impact to you at this time because you're shipping from central Kansas and most of it is headed to the West Coast, for example, or you're serving the PNW or something like that? That's not actually a very common trade, but you get my point. You're looking at what does this actually look like in your traditional trade flows, or have there been opportunities in the past that you'd like to capture, but it was the fact that it was multiple different carriers, multiple different counterparties made those trades, something that wasn't very attractive structurally. because of that. So something to think about. So we talked about the NGFA's response and sort of saying we're going to be maybe wait and see, to oversimplify.
And Joe, if I can just interrupt for a second, I apologize. I just about that point, that's exactly what Union Pacific is going to argue. And as they're going to say, look, we can get freight, just we can move things faster across the Mississippi and, from coast to coast. And it may not be as relevant for, if you're doing, shipping grain out of North Dakota or Kansas or whatever, but where it really could be very helpful would be like in the containers, the intermodal containers. A lot of those come in from California, and they'll cross over to Chicago, and then in Chicago they might have to get on a truck and then run through traffic across to the other Eastern Guys terminal, and then so they're just gonna try to make that a lot smoother. And they also talk about these these markets. Think about. I'm trying to give a good example, but I don't know, maybe like a Denver to Indianapolis or something, which might be right now, it might not be worth it to do a double rail. You need two railroads, an interchange involved to ship between those two cities. And that might just not be worth it. They're relatively two short hauls that you're combining. Now you're doing like one pretty long haul. So it becomes attractive. You don't have to change trains, change crews, whatever, just move it right through your mid-continent gateway, whether it's Chicago or St. Louis or whatever, Memphis. And that's where I think you're going to really, that's where they're really going to try to sell the benefit.
Well, I think on that point, so thanks for jumping in on that. It made me think of the fact that we see increased amount of activity and sort of, capturing incremental margin from operators that are looking at the specialty markets for, say, food grade non-GMO soybeans, for example, where they don't typically move in 120 car shuttles. They much more, there's IP preservation and protection requirements in place. There's very specific and rigid quality requirements from counterparties overseas, namely into Japan and Korea. And you see some pretty interesting and creative logistical sort of acrobatics where they will be loading 5 to 10 containers for export out of Cleveland as a way of then ultimately getting it onto a boat over to Asia. And perhaps some of these markets that have hyper-localized productive capabilities with specialty grains, pulses, again, food grade or non-GMO or organic conventional grains, perhaps intermodal agreements allow you now to, for the first time, say, hey, let's transload a bit of product on this now more integrated network. And perhaps it's going to open up some opportunity for us. Again, it's something for shippers to be thinking about is that, this could be, there's downside and upside depending on your local economics and strategy.
Yeah, definitely. No, good point. And I was just going to say railroads are definitely very bullish on transloading. They always it's another way they're trying to really drive growth. So adding new, transload points, terminals, whatnot. So good point.
Just a couple of the quick things I want to comment on. So you talked about how the NGFA is on a wait and see mode. I've seen that the American Farm Bureau Federation, as well as the ARA, the Agricultural Retailers Association, are both in opposition. Labor, predictably came out voicing concerns, as you said, that there's been some overtures, or actually, some written commitments from management to labor to bring them along. I think two things were interesting. One was BNSF's response to this, and then conversely, go and talk about the CPKC and their response to this. So, Warren Buffett, Berkshire Hathaway owns the Burlington Northern Santa Fe, BNSF. There was some early speculation, and I think actually some discussion, that BNSF and CSX being the other Eastern U.S.-based Class 1, were going to be evaluating the potential of a merger. BNSF subsequently said they're not pursuing any near-term consolidation, and that they've instead agreed to a coast-to-coast intermodal service agreement that they think is an effective alternative that will improve services without pursuing full-on consolidation. So, the initial fear was this was a knock-on effect, and we're going to very quickly go from 6 Class 1s in North America, or say 4 in the U.S., down to 2. And that seems to be not the case. Any thoughts on that? Is that just a different management philosophy from BNSF and CSX? Any thoughts there on that?
I'm going to use that phrase again. You're going to kill me for using it, but it's a wait and see situation.
That's fine.
Yeah, I hate to be to beat that stick, but I know in all seriousness, I think the BNSF and CSX would inevitably have to merge if the Union Pacific and the Norfolk Southern do merge. I think they would be at a big competitive disadvantage if they didn't. But I don't really see any reason to rush into it. And this is the point. If anybody's interested in exploring this topic even more, there's Tony Hatch is great. He's there's some other really good analysts out there, but he's always makes the point that why BN should just monitor. Maybe the UP doesn't even get approved, and BN won't have to do anything. CSX won't have to do anything.
Yeah. Maybe
they'll get approved, but with a ton of concessions that makes it, maybe they'll wind up giving, the BNSF just huge concessions that they'll have to consider before, maybe at that point they don't need to merge. So there's just a lot that can happen. So there's really no reason to jump forward. I mean, I guess if there is a drawback, it would be just, you don't want to fall too far behind. If suddenly a year and a half from now, Union Pacific is this big giant railroad, and now you're just getting started with your just planning to get married with CSX, then you could fall behind. I guess that's one argument, but it really is a wait and see approach for them as well, like it is for so many of these stakeholders. As they're watching this is going to play out over 18 months perhaps, so they're going to wait. And like you also said, BN and CSX are cooperating at a deeper level. They say that they had planned this. They made an announcement, I think you referred to, that they're going to, do some more cooperation through, was it Birmingham or whatever, establish some more lanes where they're handing each other freight. I think they started talking about that before UP even agreed to merge. So, take them at their word. That was the case. But yeah, you are seeing even the Canadian carriers. Now, CPKC came out and said, we're not interested in any other mergers. But you are seeing, Canadian National, I think they've done a few other cooperative deals as well. And, the reason is maybe, arguably, that, you can get most of the value of a merger without actually all the risks of a merger. Because, there are a lot of risks involved. Regulatory, all these concessions you're going to have to give up, just distraction risks, and you can go on and on. So ultimately, maybe it is better to just, be friends rather than get married.
Yeah.
And however, I do want to stress that if UP and NS do wind up merging, it does seem like BNSF would have to join up with CSX.
Yeah. I mean, I think you're right that you're almost going to pay a supplemental beyond the normal strategy tax here if you're UP. Just the deployment of capital and the premium to get the deal done, the focus and time of management employees, the cost of integration, the near certainty of service disruptions in the near term as you just simply work through the mechanics of bringing these entities together, the concessions that you'll make, there is a cost that they will bear up front, and then perhaps that cost is offset later on by BNSF trying to catch up. Last thing on this, I know we're running up on time here, Jay. You alluded to it. So the CPKC, which again, they merged and closed that consolidation back in 2023. I saw some reporting from CoBank that CPKC said they did not believe additional consolidation is necessary and warned that a transcontinental merger could, quote, trigger permanent restructuring of the industry and lead to, again, quote, an unnecessary wave of railroad mergers. And I thought it was interesting because the CEO for CPKC said that any major rail merger, any potential rail merger, poses unique and unprecedented risks to customers, rail employees, and the broader supply chain. I'm going to guess, me and my most cynical, snarky self here, I'm going to guess that wasn't part of the prospectus when they were selling their merger to the STB just a few years ago. So thoughts on that one, or maybe you want to leave that one alone?
Yeah, they're singing a different tune now, but that's, I guess, that's okay. Or it's your job is to look out for the interests of your company if you're a CEO. But, they also could probably, and Keith Creel is the CEO you're referring to, and he has a very storied history in the industry. He's very, very widely respected. And, the case I think he will make is that, okay, our little CPKCS merger, even today, CPKS is still the smallest of the class ones. You can't compare that to UPNS. That's
Sure.
going to just be, just behemoth. So you could see where they're coming from. Also, in the shadows, in the background, there are some investment firms. There's one in particular called Ancora. They're based in Ohio. That was the firm that was involved in the Norfolk Southern proxy battle that I mentioned earlier when we were talking about them. Ancora has been very active in the past couple of months trying to push, for example, CSX into at least exploring a merger. And I think they've probably been pushing them to merge not with BM, but also to at least talk with CPKC. So I think CPKC is kind of feeling some of this pressure too, like, the investment community or some members of the investment community might want to push them into doing something that they don't want to do. In fact, we're speaking on October 1st here, but just a couple of days ago, we don't know, precisely why, but probably because of investment, almost assuredly because of investor pressure, the CSX actually pushed out their chief executive, Joe Hendricks, who was, also a very respected guy. I mean, I've been a lot of industry conferences where he's spoken, and you just tend to hear, you always hear really good things like about him. But he's gone now, and you can see the influence and pressure that some of these investment firms can exert as well. So they're a factor in all this for sure.
Yeah, their fingerprints are on some element of that pressure and those decisions.
And another investment firm, I should say, was responsible for pushing out the previous Union Pacific CEO. So go around. I know there's a big thing in the airline industry too, because Southwest Airlines, their management came under heavy pressure when a big investment firm called Elliott Management came on board, bought about 12% of their stock, forced their Southwest to start charging for bags. Some of you, your listeners and our Southwest flyers, so you might be aware of this. But that was Elliott Management that pushed them to do that. But I digress here. I'm talking about airlines. We're supposed to be talking about railroads, right?
Yeah, nothing with wings, only with rails. Very good. Well, I know we're up on time.
Stay grounded.
Stay grounded. There you go. We were going to potentially talk about the STB process and timing, but I think we've covered a lot of ground here. But generally, with the broad strokes, if everything was to go smooth, if there was a glide path here to a decision from the STB, whether it was in support or opposition or some, something in between where perhaps they support with concessions that basically are signaling opposition. We're in a public comment period coming up here, I believe, or maybe we're in it now. So what are the major milestones, and when's the earliest that this could all come to conclusion in terms of being approved from the STB and then moving to actually close the deal?
Yeah, good. So the first kind of big step that's right now is Union Pacific still hasn't formally submitted its merger application to the STB. So it's where that's going to be, that just giant, many trees will be felled because for that document. It's that's going to be, well, and I'm sure excess of 1,000 pages.
Those printed books will surely move by rail car. Yeah. Be the most efficient way to get them there.
Let's hope so for the railroads. So that's kind of next. They're working on it now. They say, I don't know when they're going to have that done, but maybe by the end of this year. I would think so, by the end of this year. And then you'll start having, the STB will eventually hold hearings, and they'll start accepting commentary from anybody who wants to comment, whether you're a shipper, whether you're a, member of a labor union, whether you're, just some random dude that doesn't like that the trains are holding up the traffic at your, intersection in your local town. So you're just going to have this very, and that takes a long time. So they're going to weigh all of these different, comments from different stakeholders. Obviously, the different lobby groups like the NGFA, for example, being one of them, they've already indicated to the STB that, yes, we're going to be an active participant in this. If you, hold hearings, we want to send a speaker. So you'll get a lot of that. And that's going to play out really over, 12 to 18 months, perhaps. And so Union Pacific is targeting to close the deal by, I want to say the first half of 2027. Maybe they said first quarter, second quarter, I can't remember. But basically first half of 2027 is when they hope to be one railroad.
Okay. That's very helpful, not to kick the can down the road and say, don't worry about it. But if we've given you any sort of anxiety, you can at least give yourself a few weeks, dear listener, to relax and know that it's at least a year out. Jay, this has been, I think, really, educational for me and interesting to get the perspective absent ag, but then allow us to kind of in a more meaningful way dig into what are the impacts and opportunities for agricultural shippers and agribusiness in the event of a large transcontinental railroad merger. As we wrap up here today, maybe remind us again, the newsletters. We'll surely link to all this in the show notes, but the newsletters and the platforms where listeners can find you and follow you, as well as you're also a published author. Not the first author we've had on the show, but one of very few I can count on a single hand. Maybe also a little bit about your book and anything else you want to share.
Yeah, thanks for that, Joe. So yeah, I encourage everybody, if you find this useful, if you're following the railroad industry, check out my newsletter. It's on a platform called Substack. So just go to railroadweekly.substack.com. If you can't find it, just email me, jay@railroadweekly.com. I'm happy to take any questions anybody has. If anybody wants to email me, you could probably tell you don't have to twist my arm to talk about this stuff. I enjoy it. It's interesting. So feel free to reach out. And yeah, thanks for mentioning my books. So one was a history of Delta Airlines, actually. It's called Glory, Lost and Found. You can find it on Amazon. And the other one was actually, it's a book that profiles about 70, 75 different local economies across the U.S. So basically, just as an example, St. Louis, how does the St. Louis economy work? What makes it tick? What are the big industries? What are the big challenges? Why are some of the places that I profile having so much difficulty economically? Some have high poverty rates, some are thriving, so it just kind of goes through that. With the idea being, if you read this book, you'll have kind of a good sense of how the whole U.S. economy works, and kind of what its strengths and weaknesses are. So I think it's a good read if you're interested in that kind of stuff.
And what's that one titled, Jay?
And that is called American Places. You can find that on Amazon as well.
Wonderful. Well, we will make sure, again, that we link to Railroad Weekly. We'll have your contact information. We'll have links to those books in the show notes. And Jay, just thank you so much again for taking the time to join the Pacesetter Pod.
Yeah, thank you, Joe. It's been fun.
Very good. And to our listeners, thank you for tuning in to today's episode. I hope that you found something not just of interest, but of actionable value in our conversation today. And if you did, please consider sharing this episode with someone that you think would find similar benefit. It's the very best way you can support the show and help us elevate thinking around strategy execution across the ag supply chain. I look forward to having you join us again right here on the Pacesetter Pod.
This is thepodcastfactory.com.